A balance sheet gives a snapshot of the financial state of your business at a given moment in time. It shows what your business owns and what it owes at that particular date. It's used to assess the value of your business and is one of the first things a potential investor or a bank manager will want to see. If you're a limited company, you must produce a balance sheet as part of the annual accounts you submit to Companies House, HM Revenue and Customs, and your shareholders. Sole traders aren't required to submit formal accounts, but it can be useful to prepare the figures in a balance sheet format to make it easier to fill in your tax return. Your accountant can help you prepare a balance sheet, but it's important that you understand what it means. Let me take you through a balance sheet and explain it. You may want to have the web page available so you can work through the example with me. Okay, there are two sides to a balance sheet. On the left are the assets, that's everything the business owns. On the right are the liabilities, that's everything that the business owes. And the figures must balance. That means that your total assets equal your total liabilities, including equity. Let's start by looking at the left-hand side, the assets. First of all, you have current assets. This is anything that the business owns that is cash or can be easily turned into cash. In our example, we've got cash, also accounts receivable, that's money owed to us, and also stock. We could easily sell the stock and get cash for it. Our total current assets in the example are £20,000. Then there are the fixed assets. These are the things that the business owns that are used over the long term. Things like equipment, machinery, vehicles, and so on. You have to take depreciation off this. That's the value of the wear and tear of this sort of asset. In our example, after depreciation, we have total fixed assets of £1,800. Now, by adding up total current assets and total fixed assets, we have the total assets of £21,800. Next, let's look at the right-hand side of our balance sheet. First, we have current liabilities. This is anything the business owes and has to pay back within 1 year. This includes short-term debtors, maybe an overdraft or a short-term loan, accounts payable. This is monies owed to suppliers and salaries. In our example, the total current liabilities are £10,000. Next, we have long-term liabilities. These are things that the business has to pay back over a longer period. As we can see here, there's a 5-year loan of £11,000 outstanding. Finally, we have owner's equity. This is the amount of money that you invested in your business but have not yet taken out. Adding up all the liabilities and the equity, we have £21,800. As you can see, the two sides of the balance sheet balance. Total assets equal total liabilities and equity. These figures are used to assess the business performance and are a quick way for someone to see how healthy your business is. Now, next time you see a balance sheet, you'll be able to understand what you are looking at more easily.